Martin Luther King Day in the US, lighter volumes coming to the fore, China raising its reserve requirements for some banks, and of course a lot of inflation data not only out of South Africa this week, but out of China. This of course affecting the local currency today.
Hi, Eleni. Yeah, certainly the US holiday has put a bit of a dampener on market activity. It is relatively quiet after Friday's quite busy day, I have to say, and the weakness coming through in the rand. And right now, the market just adopting a bit of a wait-and-see attitude. Euro coming under pressure as the focus shifts back to the peripheral European debt woes. And for the rand at the moment, just a wait-and-see attitude emanating.
I spoke to Michael Keenan from Standard Bank earlier today, and he says that the rand could weaken to above 7 rand to the US dollar, citing around 7.05 or so later on this week. Would you say that weakness is definitely going to come through for the local currency?
Eleni, I think it's a distinct possibility that we do trade closer to the 7 level, perhaps even above that. I think there's a little bit of nervousness around. I think the rand market is short of dollars, and we have seen local bonds selling off. We have seen the gold price softening quite dramatically. Nervousness around the global debt levels. I don't think the scenario right now is very supportive for a big risk on trade, and we have seen distinct lack of exporters over the last few sessions. And with the Reserve Bank continuing to build reserves the way that they are doing, I think the market is left a little bit short of dollars. Not particularly uncomfortably so, but I wouldn't be surprised at all if we do have a run at 7 and perhaps trade slightly above 7 before the end of the week.
It's interesting, David. I mean, you mentioned that lack of exporters coming to the market over the last few sessions or so. Isn't January known as the big import month, given the fact that inventories were drawn down during the month of December because of the holiday season?
Well, the activity that we've seen up until now is a really quiet domestic picture in any case, both from importers and exporters. What we did see towards the end of last year was a lot of export selling, and it would appear a lot of that has been done towards the end of last year. So right now, from a domestic point of view, slightly quiet activity, not a lot of going on, and everybody just following international markets.
David, we've got the MPC rate decision later on this week. We also have a very interesting dichotomy playing out on a global level when it comes to the interest rate environment, with most emerging markets citing inflation as a problem and, of course, hiking rates on the back of this. But a different scenario that is playing out in South Africa. What is the bond market and the local currency pricing in at this point?
Yeah, I certainly think that we're going to have a no change announcement as far as interest rates are concerned. Certainly our bond market has sold off heavily since the last interest rate cut in November last year. I think we're now 50 to 60 basis points higher than we were in the shorter end of the yield curve. I think the market is pricing in no cut, and certainly we're beginning to see on the food front, in any case, some inflationary pressure coming through. Oil has risen quite dramatically. That's got an impact on petrol prices, so I think inflation may be under a little bit of pressure, and the good governor might be a little bit reticent to cut rates, despite the fact that we're not having any employment growth in South Africa. The two factors, of course, that are supportive for a rate cut are unemployment and, of course, the recent strength of the rand. But I think they'll hold off for now. And I think that's pretty much priced in as well.
Well, that said, David, I mean, hold off for now. That's pretty much been the sentiment from most out there in the investor community. What about going forward? I mean, given the fact that inflation, as you mentioned, the likes of petrol price increases starting to hit South Africa, food inflation is going to be a problem. And if we do see a slightly weaker currency, that means we're going to be importing some of this inflation into the country. So would another interest rate to the downside be wise at this point?
Yeah, I don't think so, Eleni. We've come such a long way during the course of 2010 as far as interest rates are concerned, and I do think there is some threat to inflation on the horizon. Of course, unemployment is a major issue, and I think government's having a lekgotla sometime this week to discuss the implementation of the new economic plan. Certainly one of those aspects does seem to be premised on a weaker rand, which means that we can import some inflation. I think it would be a little bit unwise to drop rates right now, but at the same time, I don't think we're going to see any rate hikes in the foreseeable future, simply because unemployment is such a problem.